Valued investors, with fall upon us and students back in the classrooms, it seems like a good time to reflect on the various tests that the U.S. economy and stock market have taken on and passed recently. When the economy and markets are tested, the foundation for future growth and capital appreciation gets stronger. The markets are facing some tough tests ahead, and we are now in what historically is the most volatile 8 weeks of the year for markets. But this is simply noise to the long-term investor. So let's focus on the facts. The Federal Reserve engineered one of its most aggressive rate tightening campaigns ever in 2022 and 2023, providing a tough test for the U.S. economy. Amid widespread calls for a recession, the economy chugged right along, powered by consumers who continued to spend even as rates rose. How did consumers do it? Well, stimulus helped, though we probably got more than we needed, along with low fixed-rate mortgages. Regardless of how it happened, and despite the Fed's mixed track record, the economy passed this test. The economy also seems to have passed its inflation test. The widely followed Consumer Price Index, which peaked at 9.1% year over year in June 2022, dipped below 3% last month. And just yesterday, we received August CPI, which showed continued progress, with some gray areas on a couple line items. Therefore, we really don't have a decisive move with high confidence, according to the August CPI. But this is going to put more emphasis on the FOMC meeting next week on September 16th, where they are expected, according to market participants, to cut rates by 1/4 to 1/2 point. I will note that the Fed's preferred inflation measure over the CPI index is the core personal consumption expenditures, excluding food and energy, which also continues to show steady progress. In response, the 10-year Treasury yield is down nearly a full percentage point since April of 2024, which was the highs, and mortgage rates are also down even more. Call that a passing grade, though one could still argue for an incomplete. The stock market also passed a tough test recently. On August 5th, the combination of a weaker than expected jobs report for July and too much borrowing from some overly complacent traders, much of which in Japanese yen, caused a sharp market sell-off. Stocks have since bounced back on subsequent evidence that the economy continues to grow steadily. In fact, U.S. GDP grew at an impressive 3% annualized rate in the second quarter. Despite that bout of volatility, major stock market benchmarks from both Russell and S&P produced modest positive returns in August. Gains were not just among big tech companies, as performance has broadened out. Perhaps the toughest tests for markets still lie ahead. The upcoming election and related policy uncertainty could be a catalyst for a correction. A tougher geopolitical test could come from China, Russia, or Iran. Eventually, if the U.S. debt pile continues to grow, bond vigilantes will demand higher Treasury yields. Valuations are high, despite even considering the double-digit earnings growth corporate America is generating. These are tough tests that may cause more volatility in the near term, but markets and the economy have a stellar long-term track record. So I would expect this bull market to continue to bring home excellent report cards over the long term. As always, please reach out to me with any questions. Stay safe and stay the course.